Zacks Rank Buys, stocks with a short-term buy or strong buy recommendation. Now, here are more Zacks Rank Buys. Time once again to check out a couple of growth and income stock picks for you, and we're going to do that with our new growth and income stock strategist at Zacks.com, Rob Plaza. Rob, welcome.
Thank you, Terry.
Look forward to talking about growth and income stocks with you for a long time to come. Hopefully. You want to talk about a couple of these picks that you've written about recently today, Estee Lauder being one of them. EL, the ticker symbol, on the New York, a leading global cosmetics firm, very recognizable name.
Yeah, I'm sure most people have heard of Estee Lauder, but it's a recent move into our growth and income. Not our picks that we look at on a daily basis on the Zacks.com page. Estee Lauder, the growth, the top line growth is still in the high single digits, but they primarily have benefited from a cost-cutting program implemented at the beginning of 2009. Their goal is to slash costs by about $500 million over the next 4 years.
Wow.
So far, through 2010, or through the first part of 2010, they've already cut costs by $160 million. So they're well on their way to get to that goal. And in their most recent quarter, they did beat Zacks estimates and they guided higher. So we can see the estimates are moving higher. This is for April quarter, the June quarter, and then for the two fiscal years, the current fiscal year that ends in June of 2010 and then June of 2011. So with the estimates moving up, the analysts expect those cost cuts to the company be able to retain those cost cuts as well as grow the top line.
So the street is bullish on Estee Lauder.
Absolutely, coming around. And then if we look at Estee Lauder compared to the industry, it looks pretty close in terms of all the basic relative valuation numbers. But the one thing that stands out is the debt-to-equity ratio, which is much, much lower than the rest of the industry. And it has an industry, their return on equity is roughly in line with the industry, so that shows that they're much more profitable right now.
I was going to say, that's a good thing, right?
Yes, absolutely. That's one thing you want to look at when you're targeting a big cap, a growth and income type company that you want to return that stable income and the ability to do that year after year.
Okay, cool. And then the next one that you've written about, next company, is a company by the name of Textainer, I believe is how it's pronounced, TGH, the ticker symbol. Now, you're going to have to help me with this one. They're the largest lessor of intermodal containers. What the heck does that mean?
Well, I'm sure you've heard of container companies like dry ships, whether it's you're taking grain or cars or oil, you need those big tankers.
Those are called intermodal containers?
Yes.
Really?
And now, Textainer doesn't...
I call them containers.
Well, they don't own any. They're a lessor. They
lease them out.
They lease them
Rent
out.
them out.
And it makes a lot of sense if you've got a variable sales that are coming in. Sometimes you need more, sometimes you need less.
Okay.
Your fleet might get old. Textainer will take those off your hands, and then they'll unload it and act as a go-between, an agent to sell off those containers.
All right. What's the story here?
The story here is just it's a play on improving global growth. If you look at any chart of any container company, it went way down when we had the financial crisis, and then they've started to pick up as the growth has started to at least stabilize and improve around the world.
Okay.
Textainer has been right there along with them.
All right.
But the one thing that really stands out with these guys is that their estimates have been moving up and they're steadily moving higher.
They had a strong fourth quarter.
Yeah, the fourth quarter they did beat, and the analysts couldn't get they got even more bullish than going forward. So estimates have been going up for each of the next 2 quarters and then for the next 2 years.
So basically, Street's okay with this one too.
Yeah, well, as long as the industry keeps going. It's a leverage play to the economy. If the economy were to stagnate, then the growth of this type of company is going to struggle with the rest of the container space.
Okay.
But one additional piece, if you're
Sure.
looking at compared to the industry, it is trading cheaper than the industry on a PE basis, and it does have a significantly higher dividend yield. Right now they're paying 4.6% versus a minuscule 0.11% for the industry.
All right.
So they pay you to sit around and wait while the global economy gets going.
All right. Do you own either of these two?
No, I don't own either.
All right. Check out more Zacks Rank stock pick ideas, Zacks Rank buy stock pick ideas for you on our website at Zacks.com. In that upper right-hand corner, that's where we put 4 new ideas for you each day, one in each of the investing categories written about on Zacks.com. And with Rob Plaza, I'm Terry Ruffalo.